I'm going to say this once calmly, clearly, and without theatrics, because when something is truly serious, you don't need to shout. You just need to be precise. What I'm about to share with you did not come from a headline, a rumor, or a message board at 3 in the morning. It came to me late last night, time-stamped, dated, and written by people who don't speculate for a living. They allocate capital for nations. The document I'm holding is brief, clinical, and frankly unsettling. It outlines a coordinated move involving sovereign-level money, the kind of money that doesn't ask for permission and doesn't wait for confirmation on Twitter. We're talking about commitments, measured not in millions, not even in single-digit billions, but in numbers that force markets to bend whether they want to or not. The timing matters. This memo is dated January 3rd. Execution begins Monday. That's not sometime this quarter. That's not when conditions are right. That's days from now. And when capital of this magnitude moves on a fixed schedule, markets don't get a vote. They react or they break. Now let me be very clear before anyone gets excited or defensive. I'm not here to sell you anything. I'm not here to promise prices, guarantees, or easy wins. In fact, if you're looking for comfort, you're watching the wrong video. What I am here to do is tell you what happens when entities with virtually unlimited balance sheets decide that an asset is no longer optional, no longer speculative, but strategic. Two nations are involved, not hedge funds, not banks playing games with leverage. Nations. Their funds exist to protect purchasing power, secure supply, and think in decades, not quarters. When they move, they don't test the water. They drain the pool. I'll walk you through the details shortly, how big this is, why it's happening now, and why the timing couldn't be worse for an already fragile system. But before we go any further, you need to understand one thing. If even half of what's in this document proves accurate, the silver market you think you know, the one built on paper promises, smooth liquidity and polite price discovery, will not survive contact with reality. And if this is true, silver will never be the same again. Now let's talk about the number that changes everything, because this is where most people completely misjudge what's happening. The figure in front of me is $89 billion, not pledged, not theorized, not over time if conditions allow. $89 billion allocated specifically to physical silver, and before anyone shrugs and says, "That sounds big," let me put that into terms the market cannot escape. The initial target is 50 million ounces. Say that out loud. 50 million ounces. Not futures contracts, not paper claims, not digital promises that can be rolled netted or quietly settled in cash when things get uncomfortable. This is metal, bars, weight, something that has to be dug out of the ground, refined, transported, stored, and guarded. You can't print it, and you can't just invent more of it because demand feels enthusiastic. Now here's where the illusion breaks. 50 million ounces represents nearly all of the registered silver sitting in exchange vaults. That's the silver everyone assumes is there to back the market. It's also more silver than global ETFs hold combined. And if you step back and look at mining output outside of China, you're talking about more than an entire year of production being targeted in a matter of months. At this point, the conversation usually shifts to denial. People say, the market will find supply, or prices will adjust smoothly. That's adorable. Markets adjust smoothly when buyers are price sensitive. These buyers are not. They're supply sensitive. If the silver is available, they buy it. If it isn't, the price moves until it becomes available or until someone admits there isn't enough to go around. This is what's called a supply shock, and it's not theoretical. A supply shock isn't about excitement or speculation. It's what happens when real demand collides with a finite physical reality. Think of it like musical chairs, except the music stops and half the chairs were imaginary to begin with. What makes this especially dangerous for the existing system is that the paper market assumes abundance, it assumes liquidity, it assumes someone somewhere will always be willing to sell. Physical demand like this exposes that assumption for what it is, a convenience, not a guarantee. And let me add one more uncomfortable truth. When sovereign capital of this size decides to secure a resource, it doesn't negotiate politely. It doesn't wait for pullbacks. It doesn't care if analysts think silver is overbought or undervalued this week. It executes, quietly at first, aggressively later, and by the time everyone else realizes what's happening, the supply isn't tight anymore. It's gone. That's the scale of this move. And that's why this is not normal news. Before this goes any further, I need to slow everyone down for a moment because this is where people misunderstand the danger. They hear big money and assume it behaves like other big money. It doesn't. A sovereign wealth fund is not you, it's not me, and it's definitely not a hedge fund trying to look smart on quarterly calls. A sovereign wealth fund is a nation's memory, its capital pulled from natural resources trade surpluses or decades of disciplined saving designed to protect a country's future long after today's politicians are forgotten. These funds don't wake up every morning wondering if silver is up 2% or down 3%. They don't panic. They don't day trade, they don't rage quit positions because a chart looks ugly on a Friday afternoon. Retail investors chase returns, hedge funds chase performance, sovereign funds chase security. That difference changes everything. When a sovereign fund allocates capital, it's not making a trade, it's making a statement. The asset stops being a line item and becomes a reserve. Something to be locked away, insured, audited, and rarely, if ever, sold. It's the financial equivalent of saying, this matters enough to keep forever. And here's the part most people miss. These funds don't need to move much money to break things. 1%, 2%. That's all it takes. In a market the size of silver, that's not a ripple. That's a structural event. That's like dropping an ocean liner into a swimming pool and acting surprised when the water ends up on the floor. Because sovereign funds don't rotate in and out every ounce they buy, is an ounce removed from circulation. It doesn't come back next month. It doesn't show up when prices cool. It disappears into vaults with national flags on them and lawyers guarding the keys. This is why their involvement terrifies markets built on paper assumptions. Paper markets rely on velocity on turnover on the idea that someone will always sell. Sovereign funds destroy that illusion because they don't play the liquidity game. They hoard strategically, quietly, and without apology. There's a saying in finance that volatility is risk. For sovereign funds, volatility is often opportunity. They wait for assets to be ignored, mispriced, or politically inconvenient. Then they move slowly at first so no one notices. And once they're committed, they don't reverse course just because headlines get loud. So when you hear that sovereign funds are reallocating into a small, physically constrained market, understand this. This isn't speculation. This isn't hype. This is a structural shift. And structural shifts don't ask for permission. They just change the rules while everyone else is still arguing about the scoreboard. Let me talk to you about Norway, because this is where the story stops sounding aggressive and starts sounding inevitable. Norway is not a country known for impulse decisions. It doesn't chase trends. It doesn't gamble. It doesn't swing for headlines. In global finance, Norway is the adult in the room. Quiet, disciplined, almost boring. And that's exactly why this matters. Norway's sovereign fund exists for one purpose: to make sure future generations don't curse the present one. It was built slowly, funded by oil revenues, and managed with an almost obsessive focus on preservation over excitement. This is not a fund that wakes up one morning and says, let's try something bold. When Norway moves, it's because the math left them no alternative. For decades, their playbook has been simple. Diversify broadly, avoid unnecessary risk, favor transparency, liquidity, and long-term stability. They don't need moonshots. They need certainty. So when analysts like me see Norway stepping into a physically constrained commodity, it raises an uncomfortable question. What risk do they see forming that makes silver suddenly look conservative? Inflation is one part of the answer, and let's not sugarcoat it. Fiat currencies have been quietly bleeding purchasing power for years, and central banks have become remarkably casual about it. Norway sees that. Diversification is another part. Equity markets sit near historic highs. Correlations are tightening, and traditional hedges are behaving poorly. When everything starts moving together, diversification stops working, and that's a problem for a fund of this size. But the most underestimated factor is industrial demand. Energy transition isn't a slogan to Norway, it's a balance sheet reality. Solar electrification, advanced manufacturing, all of it leans heavily on silver. And unlike oil, silver doesn't respond quickly to price signals. You can't just turn on a spigot and flood the market with new supply. Norway understands that mismatch, and they don't like being dependent on fragile supply chains. Now, here's where things get interesting. They're not trying to buy everything at once. They're not reckless. The strategy is staged. The initial phase focuses on a defined window, roughly 90 days, designed to secure a meaningful amount of physical silver quickly. Not enough to cause panic headlines on day one, but enough to test the system's limits. And that's where the friction appears, because having money and having metal are two very different things. Banks are pressured to source silver wherever it exists. Vaults feel the strain. Logistics tighten. Storage becomes an issue. Suddenly, everyone involved realizes that liquidity looked great on paper, but paper doesn't weigh anything. Norway's caution is what makes this dangerous. They are not overpaying out of fear. They are paying because they've concluded the risk of not owning silver is greater than the risk of owning it. That's not speculation. That's risk management at the highest level. When a cautious nation decides that securing physical silver is a defensive move, not an aggressive one, it should make you pause, because Norway isn't trying to break the market. They're trying to survive it. And history shows that when the most conservative players start preparing for stress, the storm usually isn't far behind. Now let's shift from restraint to resolve, because Saudi Arabia plays a very different game, and that contrast is exactly why this move matters so much. If Norway is the careful engineer measuring every bolt twice, Saudi Arabia is the architect willing to redesign the entire building if the future demands it. And when those two mindsets converge on the same asset, you should stop pretending it's a coincidence. Saudi capital is not timid. It's deliberate, but it's bold. The public investment fund was transformed to think in generations, not news cycles. It looks at volatility and doesn't flinch. In many cases, it welcomes it because volatility creates moments when strategic assets can be acquired before the rest of the world agrees they matter. That's not recklessness. That's patience paired with conviction. For decades, Saudi Arabia's wealth was inseparable from oil. That worked beautifully until it didn't. The world didn't abandon energy, it changed its definition. Electricity, solar infrastructure, advanced electronics, defense systems, all of them quietly lean on one material that almost no one talks about seriously enough. Silver sits at the center of that transition, not as a store of nostalgia, but as an input of necessity. This is where the decision becomes almost elegant. Saudi Arabia isn't just hedging against oil, it's rotating from one energy backbone to another, from a resource that powered the 20th century to one that underpins the next. And unlike oil, silver doesn't have an OPEC. There's no cartel meeting where supply gets dialed up because prices are inconvenient. There's geology and there's reality. Then there's the monetary angle, and this is where things get uncomfortable for people who prefer a single narrative. The dollar still dominates, but dominance is not permanence. Saudi Arabia understands that a more fragmented, multipolar monetary system is emerging whether policymakers like it or not. In that environment, physical assets regain relevance not because they're old-fashioned, but because they're politically neutral. Gold plays a role, of course. It always has. But silver offers something gold doesn't. It bridges monetary value and industrial necessity. You can store it in a vault, and you can consume it in a factory. That dual role makes it uniquely powerful in a world trying to hedge both inflation and supply disruption at the same time. What makes this moment extraordinary is not Saudi Arabia acting alone. It's Saudi Arabia acting alongside Norway. One cautious, one bold, one conservative, one opportunistic. Different cultures, different politics, different investment philosophies, and yet they arrive at the same conclusion independently. That silver is undervalued, constrained, and strategically important. When that happens, markets usually dismiss it at first. They call it a narrative. They call it speculation. They wait for confirmation that never arrives until the price forces acknowledgement, because markets don't like admitting they missed the early signal. Saudi Arabia is not buying silver to flip it next year. It's not chasing a headline. It's positioning itself for a future where control over critical materials matters more than quarterly optics. And once that metal is secured, it doesn't circulate. It doesn't provide liquidity. It doesn't soften shortages. It sits patiently as leverage. So, understand the message being sent here. When the most conservative allocator and one of the most aggressive allocators both decide to accumulate the same scarce physical asset, they're not making a bet. They're issuing a warning. A warning that the old assumptions about abundance pricing and availability are breaking down. You don't have to agree with their strategy. You don't have to like it. But ignoring it would be a mistake. Because when caution and boldness move in the same direction, the market usually finds out the hard way why they did. Now we get to the part most people skip because it's uncomfortable. This is where stories stop being abstract and systems start getting stressed. Because money moving is one thing, metal moving is something else entirely. And when you try to move this much physical silver through a system that was designed for paper convenience, the cracks don't whisper, they scream. There are only a few ways to acquire silver at scale, and none of them are as smooth as the spreadsheets suggest. One route is standing for delivery on futures contracts, on paper that looks clean. In reality, it means forcing exchanges to hand over metal they've promised exists. That works fine until too many people ask for the same thing at once. Suddenly, inventories that looked healthy start looking theoretical. Then you move to dealers and wholesalers. This is where the polite phone calls happen at first. What do you have? How fast can you deliver? And then the tone changes, because dealers don't sit on endless supply. They sit on flow. When flow stops, shelves empty, fast. Prices don't rise gradually. They jump because replacement inventory doesn't exist at yesterday's price. ETFs are another channel, and this is where things get awkward. Shares can be bought and redeemed for physical metal, but that process assumes the metal is actually there and freely accessible. When large redemptions occur simultaneously, it exposes how thin the margin for error really is. ETFs were never designed for coordinated sovereign extraction. They were designed for convenience and liquidity. Those are not the same thing. Then there are private holdings. Coins bars long-term owners who weren't planning to sell. This is where bids start climbing because persuasion replaces availability. People don't part with strategic assets cheaply, especially when they sense urgency on the other side of the table. Now let's talk about friction, because friction is the enemy of narratives. Logistics slow down. Transport schedules stretch. Refining capacity becomes a bottleneck. Vault space suddenly matters. Legal frameworks get tested. Governments notice when strategic materials start disappearing across borders, and politicians, as you may have noticed, don't enjoy surprises. This is where the idea of price sensitivity collapses. These buyers are not trying to optimize entry points. They are trying to secure supply. If the metal exists at $85, they buy it. If it doesn't, the price moves. Not because someone is greedy, but because that's how scarcity asserts itself. The price is not the cause, it's the symptom. Markets love to believe they're efficient until they aren't. They assume liquidity until it vanishes, and they assume cooperation until incentives change. When buyers are authorized to pay whatever is necessary within a defined window, negotiation becomes a formality. The system doesn't adjust politely. It reprices abruptly. What makes this feel irreversible is timing. This isn't spread over years, it's compressed into months. That compression amplifies every weakness. Delays stack, stress compounds, and confidence once shaken doesn't return easily. Participants who relied on paper assurances start asking uncomfortable questions. Industrial users start competing with financial buyers. Everyone realizes at the same time that there's less silver than they were told. And here's the part that makes people nervous. Once metal is absorbed into sovereign vaults, it doesn't recycle back into the market. It doesn't provide relief. It doesn't smooth volatility. It sits removed from circulation, turning a temporary squeeze into a structural shortage. You can call this an overreaction if you want. Markets often do right up until the moment they can't deliver, but understand this clearly. When systems built on assumptions collide with physical reality, reality wins every time. And once that collision begins, it doesn't rewind. It just forces everyone to adjust to a new set of rules, whether they're ready or not. At this point, people always ask the same question, usually with a nervous laugh. So, what does that mean for price? And I get it. Numbers feel safer than implications, but price isn't the story here. Price is the consequence. If this unfolds the way the mechanics suggest, silver doesn't glide higher politely. It jumps, pauses, then jumps again as each layer of supply disappears. Not because everyone suddenly became bullish, but because sellers simply stop answering the phone. The price doesn't rise to attract sellers. It rises because there aren't any. Industries feel this first. Manufacturers don't speculate, they secure inputs. When silver becomes scarce, they don't debate charts. They pay up or slow production. That cost gets passed along quietly, invisibly, until suddenly everything is more expensive, and no one can quite explain why. The derivatives market feels it next. Paper promises start colliding with physical limits. Spreads widen, liquidity thins, confidence erodes, and once trust leaves a derivatives market, it doesn't stroll back in. It runs. Retail investors, unfortunately, are usually last to understand what changed. They see volatility and assume opportunity without realizing the rules underneath them shifted. Some chase, some freeze, and some finally grasp that silver is no longer being treated as a trade, but as something far more serious. Because this is the real transformation. Silver stops being just another commodity ticker. It becomes strategic, something nations' secure industries depend on and markets can't easily replace. That doesn't mean straight lines or easy outcomes. It means uncertainty with consequences. I'm not telling you what silver will do tomorrow or next week. I'm telling you the framework has changed, and when frameworks change, prices eventually follow, whether people are ready for that or not. If you step back for a moment and look at what just unfolded, it's not a headline, it's a sequence. Sovereign capital identifies risk. It reallocates quietly. Physical supply gets absorbed. Markets debate narratives while metal moves. And by the time consensus forms, the conditions that allowed stability are already gone. This didn't start with panic. It didn't start with speculation. It started with calculation. Two nations, two very different philosophies, reached the same conclusion at roughly the same time. Silver was no longer something to trade around. It was something to secure. And once that decision is made at the sovereign level, the metal doesn't circulate anymore. It leaves the system. Permanently. That's the part people underestimate. Markets are used to flows. They're used to recycling. Someone buys, someone sells liquidity, fills the gaps, and everyone pretends that balance is natural. But when silver gets locked away in national vaults, there is no recycling mechanism. There is no gentle release back into the market when things calm down. What's removed stays removed. I'm not here to tell you to rush out and do anything dramatic. That's not my role. My role is to point out when the assumptions people rely on start breaking quietly in the background. When stability depends on metal that may no longer be available, that's not a price issue. That's a structural one. History doesn't announce itself with sirens. It shows up disguised as a footnote, a memo, a reallocation no one pays attention to until it's too late to ignore. Most people don't realize they've lived through a turning point until years later, when the before and after finally make sense. Right now, the market looks calm. Prices flicker. Commentators argue. Analysts debate. That's normal. But understand this clearly. The metal is moving even if the headlines aren't. Supply is tightening even if charts haven't caught up. The market hasn't reacted yet. But time has already started moving, and time rarely waits for consensus, especially when stability depends on something that's quietly disappearing.